In this video, I'm going to talk about the different account types, and I'm going to go in a little more detail than my previous videos. First of all, let's just briefly touch on what the account types are. Assets are economic resources or items the business owns. Liabilities are debts or money owed to others. Equity would be the owner's investment in the business or the owner's claim to the business. Revenues would be money earned from selling products or services. And expenses are your day-to-day costs of running the business or operating the business. And it's worth briefly mentioning cash versus accrual basis because these lessons are based on accrual basis. I'm teaching you as if you are taking a college class, and most of the time books that are used are accrual basis. They do talk about cash basis, but the concepts a lot of times are accrual basis. However, in practice, as I'm doing bookkeeping for different companies, a lot of them are using cash basis, so it can create some differences. Accrual basis is when you record and recognize transactions as they occur, whereas cash basis is recording things as money is exchanged. So I do try to point out those differences as I go, but I'm just pointing this out now in case there's any confusion as to why I'm teaching something a certain way. Now what I'm going to do is go through each of the account types. I'm going to give you some examples of different types of accounts that would go in that account type. And then I'm also going to go over some terminology that we use in accounting, just in case you see this terminology in other lessons. And then I also want you to keep in mind that different companies are going to name their account categories differently. So what you see on my screen are examples, but in a real business, they might name these things slightly differently. For example, I have cash, but you might see this as cash on hand or petty cash. So I just want to point that out in case that comes up. Okay, so first, assets. These are things you own, things that are resources. So this would be your checking, savings accounts, money market accounts, any cash that is on hand. And this is business cash, not personal cash. Office supplies, technically that is an asset, and we will look at this later because under accrual basis accounting, technically you would record office supplies as an asset and then record it as an expense as those supplies are used up. And we'll go over that in a later lesson. It will be an adjusting entry that we learn. Merchandise inventory, that would be the inventory that's in the store or in the warehouse that will be sold to customers. So that is technically an asset when you purchase it, and then it gets expensed when the inventory is sold to a customer. So we'll go over that too, and we will go over some very detailed inventory lessons later on. Any investments of the business would be considered an asset, and there's a lot of different types of investments. Furniture and fixtures. Fixtures would be things that are affixed to a property. Maybe you install some shelves or some new light fixtures or something more specific to the industry. Equipment would be your fax machines, computers, printers, things like that. Vehicles would be the company vehicle. Buildings, land, those are pretty obvious. And then of course we have receivables that go in this category. This would be a customer promise to pay. A general receivable is usually called an accounts receivable. So if an invoice is issued to a customer, but the customer hasn't paid yet, that is automatically considered an accounts receivable. And then if there's some sort of written promise to pay, such as a promissory note, that might be called note receivable or notes receivable. Typically, this would be more formal, and it might have interest included in the repayment plan. And then prepaid expenses, this is something we'll go in more detail about later, but a prepaid expense is an expense paid in advance. So things like paying rent, a year in advance. That's a prepaid expense. Because rent is normally an expense, and when you prepay it that far in advance, it is a prepaid expense. It is an asset because you have the benefit of using that space for several months. Another prepaid expense I see is insurance. Sometimes insurance is paid a year in advance, and that would be considered a prepaid expense. Now, if you're just paying it at the beginning of the month, that might not be considered a prepaid expense. Well, it technically is, but you're going to use it in that month. You're going to use it pretty quickly, so it would just be too detailed to try to make a daily adjustment as you use it up. I don't want to get too detailed here. Just know that this is something we are going to cover in a later lesson when we get to the adjusting entries. Okay, and then we have liabilities. All of these are examples over here on the left, and these are just items that have the word payable. It's really just any debt that is owed to somebody. It can be taxes, it can be rent, it can be utilities. Accounts payable is just a general liability, but you can get more specific in the type of liability it is. And then notes payable, that would be a more formal payable, a more formal debt, maybe with a promissory note. And then maybe there would be some sort of interest payment along with paying off the balance. So that would be more of a formal note. And keep in mind that liabilities don't have to have the word payable in them, but I used examples with the word payable. And then just because you might see this terminology, accrued liabilities, that's just another word or another name for a liability. It's a liability owed but not paid yet, which is what all of these over here on the left are. Just think of the word accrued as meaning cash hasn't been exchanged yet. And then unearned revenue, this is when the customer prepays. So this is a little different in that the business owes the customer a product or a service. So it is a debt, but it is not a debt of money. It's a debt of the product or service that is owed to the customer. And this is also called deferred revenue. And then equity would be the owner's investment or owner's claim to the business. And there's a lot of variations here of different names that you might see. You might see it called owner's equity, and I didn't put that here, but owner's equity, owner's capital, partner capital if it's a partnership. In that case, you would probably have a separate capital or equity account for each partner. If it's a corporation, you might see things like common stock or shareholder contributions. So these all represent the owner's investment, the owner putting money in. But over here on the right, I have account names that are related to the owner drawing money out. So for a sole proprietorship, it might be called owner draws or owner withdrawals. For a partnership, partner draws, partner withdrawals. Now, keep in mind that you would have a separate equity draw account for each partner so that you could keep track of how much each partner withdrew from the business. And then you might also issue dividends if it's a corporation, or you might call it shareholder distributions, especially if it's just a one owner, one shareholder business. It might be called shareholder distributions, or at least that's what I've seen. So these are some types of accounts you might see for equity. These are the main ones that I see, but of course there's differences depending on different businesses, how they want to name their accounts, and what business structure they are. Okay, and then we have revenue or income accounts. Now I put a couple of names over here on the left. You'll probably see revenue called service revenue or sales revenue if you're learning out of a book, if you're learning in a class. Service revenue would be income or revenue earned from selling services to customers, and then sales revenue would be if you're selling products to customers. And you really could use sales revenue for a service business as well. So these are just general revenue names that you might see if you're learning accounting. But in a business, sometimes they will change the name into something that's more specific to their type of business. So if it's a law firm, they might call it legal fee income. If it's a consulting firm, they might call it consulting income or consulting revenue or something along those lines. Now, you can have more than one revenue account if you have multiple types of income. Like a landscaping business might have multiple types of income. They might do some design, they might sell some products, so it doesn't have to be just one revenue account. But I try to give some examples, but of course there's so many different variations because there's so many different types of businesses out there. And then expenses are the last category. These are your day-to-day expenses or costs of running the business, things that have to be paid in order to operate the business. And I put some examples here. Notice that I did not put the word expense beside each one. You don't have to name your expenses with the word expense. And of course, there will be a lot of variations on different businesses and what they name their expense accounts. So these are just some examples. Notice that cost of goods sold is here. This would be the cost of any products that are sold to customers. Just make sure you know that that's an expense account, and we'll get into more detail when we talk about inventory. Inventory will be a much later lesson, but otherwise these should look pretty familiar to you if you have done accounting or if you own a business. I hope this video was helpful. If you have any questions, feel free to comment below, and I'll see you in the next lesson.